Welcome to Wednesday Winners. All right, so for those of you who are new, I see some new people on here. Wednesday Winners is where I come in. I'm the agent mentor for the Gooderman team, for the Lifer team, and for the Alvarez agency. What we do is we kind of take broad topics and we narrow them down. We go into the nitty-gritty detail, a little bit of the finesse of the business to help give you that edge to get better and to skill up. Couple of announcements. We still have a competition going on right now. Ask your upline. There's $3,500 on the line from Aaron Gooderman himself, first to 50K. Don't let Danielle beat you. She's already at 35K for the month. She's got 15K to go, and she's going to get $500 unless some of y'all step up and go. So again, Thanksgiving is next week, a week from tomorrow already. So you're going to get a lot more trouble with setting appointments, right? Get your work this weekend to really buff it up so that you can take the time off and relax during the holidays. After you got a couple of days, hit it right back on Saturday and start over like nothing ever happened. All right. It's a great way to keep your numbers up, and it's a great way to enjoy. I like to enjoy turkey and get my belly full while my wallet's full too. That's the only way I like to do it. So, yeah. So tonight's topic, we're going over how to raise your AP. I have a unique advantage of being agent mentor across all teams. I get to see some of the production that comes out, and what I'm seeing is I'm seeing smaller and smaller apps. And sometimes, that's due to a client's budget. I get it. But when I'm seeing a pattern, I see that we're not offering enough, right? There's a neat little book out there called Go for No. And we tend to think about our client's budget like our budget. Would you spend $500 a month on a $100,000 policy? Probably not, maybe not, right? Depends on how important it is. But that it's not your money, it's your client's money, right? It's their family you're trying to help protect. So what it comes down to is showing them enough to take you seriously and enough to really want to to be honest, just take it seriously. For instance, if you have a young couple, say they're both 30, they only have a small mortgage of 150,000, with the Leaser formula, we're going to be showing them 150 for preferred. We're going to be showing them 75 for standard, and then we're going to show them 37.5 for basic. Well, that 37.5 is probably going to be only $10 or $12 for the basic option, right? You're still going to think about it's on that, but even if they pick that, that's not that much AP. It's not really doing that much for their family. Instead, what I suggest is what I'm about to show you. Let me pull this up. So this is how I usually handle those situations. Let's pull this one up. So Adam and Desiree, this is a great way to do this. Adam and Desiree are both 30 and 33 years old, okay? They have a total mortgage of 170. So you'll see that preferred and standard are actually the same. Well, guess what? They're both healthy. So on the top option, I'm going to show them Americo CBO 50, right? It gives them an option of having some return of premium for the preferred option. But if they want to go with the regular term, they can still get the full amount of their mortgage for about $20 less. Okay. Now look at the basic. It's only $50,000 off because I'm trying to keep the basic option altogether be between $70 and $90. Everybody can come up with $70 to $90, right? If you've done your presentation right, if you've built the emotion, if you've gone over their financial analysis, everybody has $70 to $90 to spend. Plus, that's more likely to stick on the books. If you don't notice, sometimes your smaller AP will actually fall off and they'll cancel because they don't really take it that seriously. So when someone's investing $80 to $90 a month and they go to cancel it, you won't even see this behind the scenes, but they'll be like, well, we spent 6 months. We've already put like $800 into it. We'll just keep it. It's good for our family. But if they see that it's $20, yeah, let's just get rid of that. It's only $20. We don't really need to worry about it. That's what I'm talking about. So you want your basic option to be between, let's say, 60 and 85 right? I really try to keep my basic total around 1,000 annual premium so that I'm keeping 1,000 annual premium per household at the very least. Okay.
Where the covered stairs are.
Can we all mute out, please? Thank you very much. All right. We back. So that's a great way to do it. Now, the second is don't be afraid to show higher numbers. See if I have an example here. Right here, Michael and Joe, right? These guys are in their late 40s, 50s. They have a very long mortgage, right? 385,000, and they're both smokers, right? Some people wouldn't dream showing them $200 per month and $400 for a $600 total a month payment. Well, guess what? Their mortgage is $3,000. I'm still within the 20% of their mortgage for mortgage protection, right? That's all I needed to worry about. And guess what? They're probably not going to go preferred anyways, but $350 is a lot easier to swallow. If they've got a $385,000 mortgage, they've definitely got an extra $300 rolling around. And guess what? That's exactly the one they chose. They chose half the mortgage for each, right? Look at my basic option. It's still $160, right? But I'm not afraid to show them this big number, right? I'm not thinking with my wallet. I'm thinking in their best interest and showing them what they want. Gives a little bit of realism to, okay, this is what it's going to cost. I kind of knew it was going to be like that, but the standard gives them the relief. People are scared to spend money on every month. They're scared to sign up for a monthly payment for whatever reason. They're trained to be scared of it, even if it's $100. So you've got to coach them that, hey, something is better than nothing. And that's how you do it. So I'll even downsell the preferred sometime. I'll even say, if it's something ridiculous like $600 a month, I'll say, hey, listen, I probably know the preferred option is not going to fly with both you guys. Totally get it. But out of these two options, which one makes sense? Two things will happen. They'll say, yeah, we can do the standard. That's great. The preferred is definitely out of our range. Or they'll say, hey, the preferred is great. That won't mind. And you'll be shocked at what type of people you see spending this type of money on insurance. Some people take it really seriously. You can never judge a book by its cover. Okay. So those are the two ways. By buffing your numbers up a little bit, keeping your basic higher, right, will give you higher annual premium because there's nothing lower. And listen, if your client still objects to all pricing, then you can adjust. You need to make that clear in the beginning of the conversation. Hey, if we need to make adjustments, let me know and we will make adjustments, right? Now I can drop this down to 50,000, right? I can pull up my agent insurance toolkits and show them what 50,000 would be and get on the same page, right? But I'm going to make them tell me no until I find a yes. So I recommend you guys picking up Go for No because it's really going to help you. Because what if I didn't show him that? What if I just showed him 195,000, 97,000, and 50,000, and he chooses preferred? Maybe he wanted more. How do I know? Right? So I'm always going to show them the absolute max, but keep it within reason still. You don't want to go over 20%, 20 to 30% of their current mortgage payment. I'm talking everything together. So if they pay 2,000, you want to keep your preferred within $50 of $400, 400 to 450, right? So that's a great way to do that. Now, the second way that I do this is through selling accidental policies. So I'm always going to add accidental. If you don't have your health license, then you can't sell Mutual of Omaha standalone accidental, but you can sell Americo's ADB, accidental death benefit. You can get around your health license using that, but it only goes up to 250,000. The cool thing is they pay you an extra 30% of your base contract. So whatever your base contract is, add 30%. That's what they're going to pay you on Americo ADB. Okay. So I always tell clients we protect them in two parts. The first is going to be bodily injury, and the second is going to be natural causes. And I immediately ask, hey, if you were to get the car of your dreams, would you drive it off the lot with just liability? You wouldn't drive it off the lot with just liability, right? Heck no. So we want to make sure you're covered for collision and liability, right? And then I explain, hey, so this is going to cover slips, trips, falls, any accidents, any lightning strikes, anything that's non-natural. But it's a great way to supplement your coverage and get a lot of it for very little money. What am I doing by talking about a cheaper accidental or bodily injury policy? I'm getting them revved up to spend money because they're like, wow, $280 for $77 a month for both of us. That's amazing. That's, 560,000 of coverage if we both die in a car crash that's going to go to our kids. That's awesome. And then I make them choose the accidental coverage that they want before I even get to the natural causes. Out of these three options, folks, which one feels right, but most importantly, which fits your budget? Well, we'd like the standard. Perfect. You both have 140,000. It's guaranteed. They cannot deny you based on your health. So this will be instant coverage. Isn't that great? But we can't forget about natural causes. And then I'll move right into the natural causes, re-explain the living benefits. Okay. Sometimes they'll select, they won't want to select one from the regular term, right? Maybe it's MPP and they don't like it, but there is one thing, I still got them to select and get an app out of them anyways. If I didn't show them accidental, I wasn't going to get any applications, right? Because they thought that the term was too high, or they thought the mortgage payment protection wasn't worth it. But they saw the big numbers and their eyes got big because they're like, oh, I can protect my family with 280,000 for only 77. So I'm at least getting an application out of it. And I do this every single appointment. I make sure I show an accidental, right? And if the accidental is going to, mess them up and they want to go with term, get rid of the accidental. It's always nice to have something to take away. And usually for me, that's the accidental, right? If they really want the term, say, okay, well, why don't we do this? Why don't you just get rid of the accidental? That'll add another $77 to your budget. And that way you guys can go with your preferred on term. How does that sound? Great. I'm just giving them options to be able to make an educated decision and find something that's going to fit their budget, right? But I'm giving myself an extra pad of negotiation so that they don't feel pressured or they don't feel like embarrassed that their budget's not going to fit. I'll have that there. Is that making sense? I know that was super quick, but let me recap again. So first, what we're going to do is you're going to buff up your basic options to around $60 to $80 or $60 to $85 between both or the single option. Okay. If you've got really young folks, add an extra 50,000 to what they currently owe. So if someone has a $150,000 mortgage, make the preferred option 200,000. Make the standard option their full mortgage, and then just subtract 50,000 from that. That's going to keep you in that range. And how I explain it to them is preferred. What you can do here is that if you have any extra debts or you want to leave some extra behind to your family, pay for your funeral, that's what that's there for. The standard's going to take care of the whole mortgage. And guess what? Half the time they take preferred because they'd like the idea of leaving extra behind to their family. Okay. So once we've done that, we're making sure that the top option, we're not scared to show them the large front end option, right? It's a game of elimination, guys. If the top option doesn't work, guess what? Now they only have two options to choose from. That's a lot easier than trying to decide from three. So we can slash and take away the preferred option right off the table, and then we can focus on two options. And they're going to go with preferred or basic. At least I know with basic, it's $1,000 annual premium, right? And the second way is selling accidental, showing them accidental every single time, no matter what. That's what you're going to show them. Okay. So let's start off with some questions. Diane Crump, that was speedy.
I'm sitting here thinking. So my question is, when I'm doing my applications for the mortgage protection, now you starting off with their full mortgage and then half and then that, when do you switch it to 36 months, 24 months, 12 months of payments? What's the difference? How do I decide what I'm doing?
So usually with someone who's not healthy, we're going to go mortgage payment protection, which is 12, 18, 24 months of their mortgage.
Okay.
And I always show them accidental. If they're under 70
Okay.
years old, there's an accidental policy out there.
Okay.
If you don't have your health license, they've got to be under 60 because that's the limit for America ADB.
Okay.
Guys, it's a 60 question, it's a 60 question license test. So it's pretty quick and easy. If you're on here and you're not licensed yet, and you're thinking about doing this, just get it all done out of the way at the same time.
Yeah, do that.
Yeah. Any other questions? I know we got some questions on here. Kobe.
What's up? So you make sure that your basic price is between, you said basically $60 and $90, right? So in doing that, like if they're young, how do you figure out, okay, you do the preferred, because I mean, we do 150, then 25. How do you do the middle standard? What do you normally go with that?
Yeah, so typically if they're younger, for rule of thumb, I'm going to add $50,000 to their mortgage and make that the preferred. Then I'm going to make the standard their mortgage, and then I'm going to make basic half of that. That's going to generally keep me in the range, right? And you guys can experiment. Sometimes I'll add an extra 60,000. And then, sometimes I'll just make it look even, but I'll make sure that my basic is hitting where I need it to hit. Okay. Now, when you're talking to people, right, it's a process of elimination when it comes to their decision. So if they don't like the preferred and they don't like the standard and they don't like the basic, here's where I go. I'm either going to stick them with the accidental and say, okay, great, that's totally okay. At least you got accidental coverage. What's your middle initial, right? Sometimes when people don't like their term, they'll kind of totally unravel and be like, no, we're just going to think about it. They'll put the stops up. Here's how I handle that. Well, listen, Chad, you're the one working full time. Your wife stays at home and she takes care of the kids. Obviously, there's a larger financial vacuum if you pass away. Am I right? What does that look like for her when you do? Mary, let's talk about this. He goes to work tomorrow and he doesn't come home. What's the next 30 days look like for you? He tries to pipe up. I'll say, hey, you're dead. You can't help. You can't say anything. I'll be that serious. I'm going to be dead serious, right? Because I'm trying to get that point across. And I say, why don't we do this? It sounds like, John, you'd be more financially stable if she passed away. Yes, it would be tough. There'd be a lot of grief, but you could handle it, right? So why don't we get the protection where it's important right now, and then we can talk about getting protection on Mary later. So then now, not only did I narrow it down from those three options, now I just made them think about one option, which is for him, right? Where it's really important. And what you'll find, instead of him going with the basic, he's going to go standard with preferred, because standard or preferred is going to still be less than what standard and basic are added together. Typically standard is still going to be for just him, is still going to be less than basic added together. Is that making sense? So that's a good way to handle that. Danielle, what do you typically do when you show her numbers? Because you have really great AP per application.
Yeah, so always mortgage payment protection. I automatically always do MUAX, of course, if they're in the age limit. So I present that first and I say, but we cannot rule death of natural causes. So we're going to treat this as buying time, because you have to understand the concept of mortgage payment protection, and you have to sell it throughout the whole meeting before you even get to the options. And so at this time, we're going to say, okay, so we're going to find a time, most clients like anywhere between 6 months to 2 years on the mortgage to be taken care of, because number one, they're going to figure out, do they want to stay in the home with all of the upkeep, or do they want to downsize and sell it and take all the equity? So that's what we're going to build for you. But bodily injury and accidental, you're taking care of the full loan amount. Let's just make sure death of natural causes, you have that time in place as well.
Mm-hmm. Yeah, it's making them feel comfortable with a comprehensive coverage, right?
Yes.
They know at least one way their family's going to get the loan paid off, and at least other way they're going to get 2 or 3 years, or maybe 18 months of mortgage payments to allow them to collect the equity. I used to struggle with mortgage payment protection like no other, but really it's just the concept of using what they have now and making sure that they have a shot, because something is always better than nothing, always, right? And I'll ask them, if I showed up tomorrow, if John passed away with a suitcase full of $25,000, would you be happy about that? And they would obviously say yes, and that's what you're doing for them, because now that money buys you time. That's important. Thank you, Danielle. Very helpful.
Can I make, go ahead, Kobe.
Colby, is that you again?
Yeah, as a rule of thumb, we see what it is for mortgage protection. Rule of thumb for mortgage payment protection. I mean, do you kind of do it just dependent upon the client? Is it 12, 24, 36? Is it 6, 12, 18? How do you normally get that figured out?
So yeah, it's I work from the basic up, really. So if they're in their late 70s, I know it's most likely going to be a 6, 12, 18 month kind of deal. Because that's where it's going to fit best. And the 6 months is going to be at least $50 per person. Okay. If they're a little bit younger in their 50s, obviously I'm going to step it up and do 12, 18, 24. But I just encourage you to play with the numbers and really just make sure your basic is the one that has that, $60 to $80 range, right? And then move it forward, because you can always negotiate downwards, right? Does that help, Kobe? All right, Jared.
Absolutely.
Yeah, man.
Oh.
I was just gonna say on mortgage payment protection, exactly what you just said. Just kind of playing with the numbers. I start at basic, and I personally put my lowest option around $80, 75,
Mhm.
$80. That's where I put
Yeah.
my lowest option. But again, that's just to help get my AP up.
Mhm.
Because we can always go down, but you can't go back up. Once you've shown them that low one, and that's the one they like, that's the one they're going to go for.
Mhm.
But a real popular version of mortgage payment protection for me, I'll do 6, 12, 18 or 9, 12, and 15. Those kind of tend to be magic numbers based on the mortgage amounts where I am, where I'm selling. But it does depend on your mortgage amount too, because I mean, if somebody has a super high mortgage and they're older, you might not, your top option might be 6 months if
Mhm.
their mortgage is $3,000 a month, so you go based on price.
Mhm.
So that's all I was
Absolutely.
just gonna add to that.
Yeah, I appreciate that. The other thing that you kind of remind me of too, if they're super young, then you could always go with like the full amount. So let's say I have a 50-year-old who's got Crohn's disease and they can only get final expense, right? Or they can only get MPP. Instead of showing them 6, 12, 18 months, I'm actually going to show them the top option is 40,000, 30,000, 20,000. So it's just about experimenting and playing with your numbers and what's going to best. Because the more that I can show them, the more they've kind of got a peace of mind, right? It's hard to show someone little numbers for death benefits already to begin with, right? But if you can show them more, that's just going to help your case. All right, Diane.
So I just wanted to add, when you were talking before about the mortgage payment protection, I don't know which one of you said it, but somebody said the equity in the home is what they need to focus on, that they're going to receive when they sell that. So that helps them realize the benefit of the 6 months, 12 months, 8 months, 18 months.
Right.
That's
So
what finally made sense to me. what
yeah,
we're-
so basically what I'm doing is I'm asking them, you know, in the beginning when I do the financial review, I'm asking them, okay, so you've refinanced this house. How much was it worth? What did it get appraised for? Like, how much did you get? Right? I'll be excited about the equity. Well, we refinance 198,000 to take care of these debts. It's worth 400,000. Right? Now, what if the wife can't now a 198,000 or $200,000 mortgage, that's going to be what, $1,500 a month,
Mhm.
right? So I explain that the bank has 90 days before they're going to start foreclosure process. Trying to buy a house in 90 days, how hard is that? Anyone who's bought a house realizes that it can take months to purchase a home, 5 months.
Yeah.
So I'll say, let's say the average is 5 months. 5 times 1,500, not including your other bills, is $7,500 to come up with before your house forecloses to try to sell it, right? And by not having that $7,500, she missed out on 200,000 in equity. You don't want her to miss out on that hard-earned equity, do you, sir? Right? That's where that comes into play. So a lot of these people, oh, we'll handle it. And then I'll do the math right in front of them. Well, I don't have $7,500 in the bank. This way you do. You're going to buy her time to give her peace of mind and not have to stress about selling, right? Give her 12 months. That's plenty of time, right? Even if a deal falls through, she's still got plenty of time to make it happen, because we're not guaranteed anything but death, taxes, and a death benefit. All right. Those are the 3 things that we're guaranteed in this life. Okay. So why don't you give her a good death benefit to make sure she has that time?
Hey, Lake, can I tap in on that too?
100%.
So all life insurance is assigning a purpose to a dollar amount. That's it. And this purpose of this dollar amount, even though it's only $7,500, like what Lake was saying, the purpose of it is to protect the 200, because without it, the 200 is in jeopardy. So that is the real prize. You don't want to not protect your biggest asset. So we're just assigning a purpose to it. Hey, this money is going to be allocated to this, period.
Absolutely. Thank you, Jared.
And like, real quick.
Yeah.
So Diane, I tell a story too. Stories sell. So at that time, I talk about my best friend where, you know, she was married at a young age, but she also lost her husband at a very young age. And he was healthy. Like he, you know, ran 5Ks, played golf, you know, he was a hard worker, and she was basically the homemaker. So I tell people don't understand that when you lose someone, not only do you lose the love of your life, but you also lose the loss of the income. And bills don't stop just because you lose someone. And the bank's going to feel sorry for you, but at the end of the day, all they want is their money. And unfortunately, when she lost him and his income, she could not afford the bills, let alone the mortgage that they had. And so the bank basically took the home, and we calculated it when that home sold, and she lost over $100,000 of equity in the home that could have been for her and her 5-year-old daughter, because all she needed was time. She needed 5 months on that mortgage to be taken care of, to sell the home and take all that equity. But she wasn't on her timetable, she was on the bank's. And so that's why you tell a story. And even if you don't have a personal one, you know, take mine, or, you know, Lake and Jared has great stories, but stories sell. You have to make it real to them, because if you're just logically talking, and I was very transactional last year, but now you have to logically and put emotion in there to really have them understand.
Yeah, absolutely. Absolutely. That's gold stuff right there, guys. Yeah, I mean, I went into a house one time and, you know, we were talking about mortgage payment protection and I talked to the story. I told the story that I usually tell about mortgage payment protection. I used Josh's story. Um, but these people were talking to me and said, yeah, we feel so bad for the lady next door. Because as I was talking to this about the story, they were looking at each other and being really worried. And I was like, what's going on? Well, the 90-year-old lady that lived next door, her and her husband had bought their dream home 5 years ago, which was that lake house. And when he died, they lost everything. That home had 300 feet of water frontage on a really popular lake, and they only owed like 150,000, but it was worth $550,000, and she had to sell it. She lost all kinds of equity because she had to sell it in a hurry. And that's what I don't want to do. So obviously that it connected with them, right? It reminded them of the story of the next door neighbor, and they didn't want that to happen. So Jeffrey.
Yeah, hopefully this question isn't like way off, but I had an MPP appointment a couple weeks ago, and so once I told them well, I explained what MPP was and how it works, and then what if someone comes back and they're like, what if she doesn't want to sell the house? He was talking about his wife.
Mm-hmm. Hey, I totally get it. I totally understand that she wants to keep the house, right? But what if that's not an option? If you died tomorrow, is that an option? Can she keep the house? Do you have enough in place right now to hang on to the house? What are they going to say? No, we don't. Otherwise, you wouldn't be speaking with me right now, right? If you had enough to take care of the house, your investments and everything, we wouldn't be speaking together. So if she unfortunately had to sell the house, wouldn't you want her to get the most out of it? Right? Because the bank will come in and they'll take all your stuff out of the house and put it on the lawn. They don't care. They just need to, they'll short sell it and get rid of it and be made whole. Jared, I remember you had a great point on that.
Yeah, so I always say, hey, I totally get that. That's your plan A, but what's your plan B? And you just shut up and listen. Hey, I get getting that house paid off. That's plan A, whether it's we find the money or we win the lottery or we live 30 years or whatever it is. Plan A is paying off the house, but what's your plan B? And that's why we're here. We're here to cover our six. It's a term we use in the military for somebody that has your back. We're going to cover your six with this. And if we get plan A, that's great. But we're talking about plan B.
100%.
Appreciate that, guys.
You got it. Stephanie.
So to kind of piggyback on that, they may have been thinking that they're just going to go find someone else who will cover them for the full mortgage because that's what he sounded like he wanted. So how do you position yourself as, okay, these are your options medically? You're not going to find someone else who's going to give you the full mortgage.
Yeah.
Why are you looking? Stop
Education.
Yeah, it's education. Yeah, and usually I do that when you're walking into a home with someone. You're going to get some people that don't have any expectations, but or who don't understand the expectations. But if you go into a home where someone has, diabetes with complications, they're sick. They know they're sick, and in the back of their mind, they're like, I don't know if I'm going to qualify for this. So what I'm going to do in the beginning, and this, I'm going to say, John and Mary, obviously, if this was free, we'd already be done by now, right? So it's not, but if we can find that sweet spot, is there anything that's going to hold you guys back? No. Okay. Well, we obviously know this is based off age, health, smoking status, and all that. And John, by the way, even though you have severe Crohn's disease, I can still get you some coverage. How's that? Right? So I'm putting in his head that, okay, so I know that I can't get all of it, but I can get some coverage. Right? And I stay excited about that coverage. Hey, I can get you some coverage. Isn't that great? You still have a chance to protect your wife. Right? And usually that'll wipe the rest of that off the board. Danielle or Jared, I'd like to hear your opinions on that.
Yeah, so I love that. You always talk about what you can do, what you can't, not what you can't do,
Mhm.
right? So when I'm talking to somebody and I'm going to go mortgage payment protection, let's say they're older, right? And we're going mortgage payment protection, and it's just a crusty old dude, and he wants to be sure that house is totally paid off, right? I do the plan A, the plan B, all that kind of stuff. But then before I even get into that, I preempt the his thought process, and I start selling against term. When I'm going to be showing final expense, a smaller death benefit, I sell against term. So Jim, you're 70 years old. Now, I want to tell you a couple of things about this policy. Number one, it is never going to expire on you. A lot of these plans out there, the ones that show the really huge death benefits, they're going to expire on you in 10 to 15 years. You're pretty dang healthy. I think you're going to be 10 to 15 years. And then you're 85, looking for coverage. So this coverage is never going to expire on you. The other thing that this coverage does is it's locking in your rate at your current age and your current health. So it's never going to go up on you either, like a lot of these policies out there. So this is the best plan, and it's my most popular plan for people in your specific situation.
Mm.
You always talk about what other people are doing. Everybody wants to do what other people are doing. This is my most popular plan. And it's all how you position it, and it's all how you talk about it, and it's what you believe in. Because the first time that I was selling MPP, I was like, ooh, I don't know if I believe in this. But the person that I was talking to, I delivered it in such a way, they were so freaking excited. They're like, this is exactly what I need. And from that moment on, I was a believer.
Mm-hmm.
So they're like, we've been looking at all these crazy high dollar things. I like, you probably have gotten salesmen in here. They show you the high dollar things, and it's going to run out on you. And then you're going to be 85 looking for more coverage. This is never going to expire on you. I don't know about you, but when I took a shower this morning, I looked over my shoulder. I did not see an expiration date. I don't know when I'm going to go, but I just know that I'm going, right?
Yeah, exactly. Love it.
So,
You know, and I just got hit with it for my first time. I had a lady call me. I talked to them a year and a half ago. Her husband was 81 at the time. Okay, he was 81 at the time and in really good health. I mean, this guy got a preferred option with Transamerica at 81 years old. That's pretty crazy, right? And they didn't want to do it. They did not want to do it. Oh, it's too expensive for too little. And, you know, I got emotional on it again. Well, it turns out they decided to go with it. And, you know, just a few days ago, I got a call from his wife that he had passed suddenly. Right after we had gotten him approved, about 4 months later, he got suddenly ill and struggled with a really bad illness for about a year and passed. And now she's getting 12 months of mortgage payments. So it's works, guys. She owns property on a small island out in the ocean in Maine. She'll make good money off that for sure. But it's all because of that $7,500 that her 81-year-old husband got covered with to help her do that. Paul.
Yeah, like, so I just want to piggyback a little bit on what you all said, and then if you want to toss in something a little bit on here as well. A lot of people, you know, let's say someone's 65 years old or a little bit older, so you assume kind of final expense, but let's say they are healthy, medication list, they still qualify, you know, with term products and stuff. And if you go, let's say, you know, 40,000 or 50,000, well, final expense goes to 40, except CVS if they're younger. But let's say 40,000 final expense, you know, it could be 180 a month. Whereas you could show them an Americo term policy for 15 years that has those living benefits that they could more than likely access. And then that could be like $70 a month. So, you know, how would you also kind of recommend, you know, for newer agents, you know, writing MPP but not necessarily only going towards Transamerica or CVS for final expense, and then still considering, that term product.
Mhm. Well, the great thing about America and Healthy People is that they give really long terms for old people. So I think at 70 years old, you can still get a 20-year term. And that's kind of unheard of. So that's the only time I'm comfortable with doing it for older, healthy folks. But the other thing that you can do is you can still do MPP, but you can do like 2, 3, and 4 years. And you can do that with the SUL. So you're not showing them the entire mortgage, but you're still showing them a permanent policy that's in place. And I've done that many, many, many times. So I'll show them 2 years as the basic, 3 years as the standard, and 4 years as the preferred. So anything that's over $25,000 in that situation is going straight to my SUL. Usually, the basic option or standard option are going to be within $10 of each other, because a final expense under $25,000 is almost going to be as much as a $25,000 through an SUL, because that's a standard product, right? So that's a great way to really buff it up and make it more attractive to your client. Cool. Any other questions? Let's go. We've got a few minutes. Going once, going twice.
LWAC.
The LWAC, yeah. Kim, you don't have any questions?
I do, but I'm just absorbing it in the moment.
All right. Absorbing's not a bad thing.
I mean, when you
Yeah.
started, because I got on a few minutes late, but when you said that, you keep the basic higher, but you said basically just starting out, you just take like the mortgage, what they have to pay off, and then you subtract, you add 50,000 for preferred, take away 50,000 for standard, and then basic is half of what, the standard or the
Sometimes if the half is too little, like if the standard and basic, like if they have 100,000 and 50,000 is too little of premium, I'll just do, instead of doing half of the standard, I'll just subtract 20, 30,000, 50,000, just to keep that basic around a good number
okay.
for premium. So, yeah, and I encourage you to show your numbers to your uplines. That'll help you kind of adjust and see the pattern. You already post your cases in there. I see a lot of your cases. I help you with a lot of your cases. Diane does this really well. Diane will show me, and has in the past, Diane has showed me her numbers before an appointment, and we're able to make quick adjustments if needed. So with that, everybody, next week is Turkey Week. We are still having Wednesday winners next week, unless something comes up, but we should still be having it. Next week is special because Nelson Alvarez will be on here to help show us referrals and the emergency response system that the TLG has put in place to help us get referrals. Why are we doing this? You guys are all going to be going home and having turkey with your family. This is a great way to start getting referrals out of your friends and family and get extra annual premium without having to spend any money on leads. Okay. So love you guys. Catch you later, and we'll see you next week.
Thanks, everybody.
Thank you.
Yeah.
Bye, y'all.